Today's strategy session, U.S. stock valuations, they remain elevated. U.S. equities trading at a 60% premium to global stocks. But our next guest says that there's no catalyst coming to normalize valuations. Joining us now is Matthew Palazzolo, who is the Bernstein Private Wealth Management Senior Investment Strategist. Great to have you here with us this morning. So why? Why is there no catalyst in sight to normalize valuations from your perspective?
Well, look, as we enter into 2025, you have to look at the U.S. economy, and it's on fairly solid footing. The labor market continues to chug along at a decent pace. Consumer spending also chugging along at a nice clip. And so there's always risks to the economy, exogenous shock or otherwise. But from our perspective, it's hard for us to make the case that valuations all of a sudden are going to go back towards something like the long-term average, at least for now, until we get clearer evidence that there's risk on the horizon.
So Matthew, what do you do, or how are you advising clients and moves that they should be making with their portfolio?
Yeah, so we're diversified investors. So we want to ensure that we're lining up our clients' asset allocation with their long-term goals. We continue to like U.S. equities. We have a modest overweight relative to global indices. So we're big U.S. investors. But we want to underscore the importance of being non-U.S. investors as well. Valuations, as was just said a second ago, are at a steep discount relative to U.S. equities. And there's a fair amount of concentration in the U.S. market, particularly in the S&P 500. So we want to remain very diversified by sector, by capitalization, and by geography, and also fixed income. Given the level of yields today, we think provide a particular amount of attractiveness because you can just collect yields and not even assume rates are going to move one way or the other. You can collect 4 to 5% in high quality bonds.
Matthew, going back 1 second to your valuation point there, are we due for a 5 to 10% pullback, and would that be considered healthy at this point?
It might be considered healthy. 5 to 10% sell-offs happen often enough in the markets, and so you have to assume that that's going to be the case if you're invested in stocks. But again, our models are assuming that we get earnings growth of high single digits in 2025 and into even 2026. And if you assume that valuations stay north of 20 times earnings, then you're going to get a return on the market pretty much consistent with the level of earnings growth. And so absent any other news to interrupt that assumption, and that would push valuations much lower, whether it be a recession or some exogenous shock, then I think that's the safest bet to make as we look out over the next 12 to 18 months.
As we think about what's really driven the broader narrative that has ballooned valuations to this juncture, it seems like, look, this AI thesis that is baked into a lot of portfolios and has really led an overweighting or an overcrowded trade into some of the Mag 7 and NVIDIA as the AI poster child. As we're thinking about that, do you believe that companies grow into those valuations, or there's a better chance that those valuations get tested next year, and for the companies that are not able to show investors that they're able to deliver on those return on investments and the CapEx that's being spent, that there's some shrinkage in those valuations?
That certainly is a risk. The concentration, the execution of those businesses to this point has been exceptional for many of them. That's why they're at the top of the index and has performed so well when you look at their stock prices. So that's something that we have to watch for. Again, if our portfolio managers and our analysts, it's their job to determine which of those stocks they want to own and not to own. But any investor that's overly concentrated in the names at the top of the index certainly do have a risk that if there's a mismatch in expectations relative to execution, that we could see a sell-off. Now, if you look beyond the top 7 or top 10 stocks in the index, there's obviously less expensive valuations. And so a diversified portfolio is going to own stocks that are trading at 17, 18 times forward earnings, which is much more in line with the long-term average. And so you've got some valuation risk management there by remaining diversified and not being overly concentrated in the companies that have done so well for the last 12 to 24 months.
Matthew, given the fact that it seems like Wall Street's kind of having a tough time really wrapping their heads around what exactly a Trump administration 2.0 is going to mean for the markets, just given the news that we're getting on a daily basis, is it safe to say that we are going to see this increase in volatility then going forward? I guess, what should investors be expecting?
Yeah, so I think the last 48 hours or so is a great example of what we can assume for the next 4 years and what we had a couple of administrations ago. It's a tug of war. It's a push and pull where you get market-friendly news like we did over the weekend with the Treasury Secretary naming, and then today with the announcement of some tariffs. So volatility certainly is going to be one of the key themes over the next 4 years. It always is, but I think now, given the what's going on in Capitol Hill, we can expect more of it, or more being centered and deriving from what happens in DC. And we're going to go from day to day. We're going to have good market-friendly news, and then others where that serves as a counterpoint. Look at the policies as well. You've got positive policies in terms of potential tax cuts and deregulation. On the other side, you've got tariffs and immigration. So just starting with what was talked about on the campaign trail, I think is a great example of the volatility that could come for the next 4 years.
Matthew Palazzolo, Bernstein's Private Wealth Management Senior Investment Strategist. Thanks so much.